I guess we could get started. What do you think?
Yeah, yeah, I think so. Hi, everyone. I'm delighted you could join us today. My name is Samantha Taylor, and I'm the Senior Analyst here at iFi Global. As you doubtlessly know, we have expanded the content of the discussion we are having today in order to take into account some significant governance failures in private markets. We will still be covering digital risk governance, which was the original intention of this webinar today, though. Simon Osborne and myself will be taking you through what we are coming across at the moment for approximately 20 to 25 minutes. And then we'll have a period for questions at the end. We very much welcome your questions. So please do use the Q&A button at the bottom of your screen if you would like to raise a point or ask us a question. I will now hand you over to my colleague, Simon Osborne, who is the CEO of iFi Global.
Uh, Thank you, Samantha, and welcome to you all. We are delighted, as always, to see that we have people joining this discussion from multiple different countries and jurisdictions. As Samantha says, we have decided to widen the content for today's presentation in light of some very interesting and very recent failures that have just become apparent in private markets. We fear it is very likely that there will be more, potentially even many more of these to come. And it is something that we are keeping a very close eye on at our governance publication, the NED. For those of you who don't know us, I should just mention that iFi Global is a research and media house based in the City of London. We have three monthly publications and one weekly. And one of those monthlies is The Ned, which is 15 years old this year. It started as a publication focusing primarily on fund board issues and on independent director matters. And particularly over just the last few years, it's very much expanded out from that into private market governance overall, and in particular into risk issues or risk governance or risk oversight, depending on which term you use as well. And we are now in the process of launching this spring the private markets risk monitor, which will be a major part of the publication, almost a publication within the publication, focusing primarily on the kind of topics that we are going to be talking about today. So, the topics that we are talking about today are the following. We are going to touch upon some very recent private market failures. We're going to also mention, and one of the reasons we think there have been some of these failures, not the only one, but one of them is the growing complexity in the structures in private markets. It's really come up in the last few years. And we're going to touch upon also a subject which does require, we think, a lot more discussion than it has had to date, which is being the quite substantial growth of direct investment by LPs into the markets or into certain areas, particularly in sustainability, into renewables and some of the areas like that they have not been going through any form of collective structure. They've been doing it directly, and in some cases, that's causing problems to them. We will touch upon three strategies where the problems are perhaps more prevalent than they are in other areas. That is obviously private credit, sustainable investment, and in the digital asset management industry as well. And coming on to what we would have talked about in more detail if we were only doing as we originally intended, digital asset management or digital risk management was the original idea of the discussion today. We're going to highlight some of the bigger issues in summary in digital infrastructure, including in data centers, which is a really interesting issue we'll get into in a few minutes' time, in crypto and in stable coins and in tokenization. And as Samantha says, Samantha and I are going to talk for about 20 minutes or so. We're not exactly certain, but around that. And then we will get into hopefully some questions if you have any. And we aim to finish at or before about quarter to the hour. So let's get started. So these are just in the last few months. These aren't all the private market failures, even over the last year, just in the last few months that we have come across, and there's doubtless other ones we have not come across as well. We'll talk about some of these in a little bit more detail in a few minutes, but we thought it would be a good idea to put them up on the screen all in one go. MFS is the most recent one. I'm sure many of you are familiar with that. Samantha, is there anything before in the four items we've listed here under private credit? Is there anything you want to say at this stage?
Yes, so obviously MFS is the most recent. We'll touch upon this in more detail later on. Then back in November last year, HP S Investment Partners had their telecoms receivable fraud. Tricolor and First Brands were around September of last year. So we had four major private credit kind of frauds within the last 6 months. Now, what I really want you to take home from this is that you can't view these in isolation. It's not just a one-off fraud that's occurred a handful of times. It shows systemic, significant issues, that being governance failures within private credit. And then below, recently, within the last few months, you've had major private credit funds altering their redemption terms. Obviously, Blue Owl, BlackRock with their HPS fund, and also Blackstone. So it kind of shows a lack of investor confidence within the asset class itself.
Yeah, and those are just three we picked out because we haven't got the time to go into it all. There's been many more. Those are three obviously very, very, very well-known names, and if they're doing it, you can guarantee there are others that were doing redemption, altering their redemption terms too. So the point here is that there's more going on, perhaps under the surface, in private credit that hasn't necessarily been picked up by the financial media yet, but probably will be at least in certain cases.
Mhm.
And the other areas we mentioned here on the screen, real estate, sustainable investing, and renewables. Again, some of these, if not all of these, we're going to touch upon in a few minutes' time. But before we get into that, is there anything you want to say at this stage?
Yeah, again, the frequency of the pension fund cases coming to light is also interesting, which may draw questions as to, are the pension funds really doing thorough due diligence when it comes to their private market investments? So on the screen, we obviously have BVK, which is a major German pension fund. Now, they've just reported that they have three failed US real estate investments into development and also restoration projects. I believe as of today, I think losses are totaling around 800 million euros. Moving down into sustainable investments, obviously you have Michigan Employees Retirement System. They also mentioned down below renewables, but the first instance is their failed direct investment into a Hawaiian coffee farm, which has brought them recent they're being sued by an agricultural lender from Florida for about, I think it's $40 million for misstatements as to the health of the business. Again, back to Germany, we have the Dentists Pension Fund, VZB. Now, this is quite a catastrophic loss. They have reportedly wiped out over half of their capital through private market investments recently. Moving down into renewables, Aberdeen City Council is suing on behalf of the North East Scotland Pension Scheme for a failed investment into Swedish wind farms. Now, they're suing Hermes for the suitability of the wind farms, which relied on base load power purchase agreements as a core portfolio within the infrastructure fund itself. that is quite an interesting case to watch, as it may have, you might see other local government pension schemes jump onto this. And then down below, finally, we have the Michigan Employees Retirement System again. Now, this is a clear due diligence failure on their part. It Their case pertains to, again, a failed renewable energy investment, but they failed to spot a conflict of interest for the two principals, which allegedly misappropriated pension fund capital to regain their personal investments. So a lot is happening
Yeah.
on the pension fund front.
The risk of repetition, we can't emphasize this enough. This is just the last few months. If we were doing this
Mhm.
6 months ago, or we're doing this 6 months in the future, there would be another set of them here. And the point that Samantha made, I think, is the beginning of this little segment, which is this: don't see these things in isolation. They're all part of systemic governance failures. Right. And one of the reasons we are potentially in private markets getting these systemic governance failures is the structuring has changed quite significantly. Perhaps people don't appreciate how much it's changed in the last few years. I've been doing this job for far, far too long. And I remember the good old days when most institutional investors, LPs, call them what you want, would go into a traditional private fund. We all know what those are. In the last few years, there's been an extraordinary growth in co-investing funds of one. Managed accounts, by the way, also, which is not what we're talking about today, have been going, particularly in the US, they even started to go retail. So that's all really taken off in the last few years. And then you have, alongside that, proliferation of different types of ways of investing. By the way, on top of pension funds in particular and sovereign wealth funds, just investing as they always have done and always will do directly in various firms on their own accord as well. But then you have these, and also at the same time as this growth of structuring differences, you see these different vehicles coming along, and making life more complicated in that sense too. Again, Samantha, would you like to comment on that?
Yeah, I would just say that the what we're seeing from our environmental investment monitor and monitoring LP allocations to sustainable investments, you are seeing a growth in co-invest. This does raise questions as to whether the LP is conducting thorough due diligence. Obviously, with a co-invest, you have a very short window to seize this opportunity. They may be attracted by higher potential internal rates of return, but you really need efficient governance to mitigate the risks and to really know what they're getting themselves into. And on the long-term investment vehicle side, questions do pop up as to whether the LP and their advisors understand the kind of the nature of the vehicle and some kind of whether there's liquidity mismatch, whether they can fully assess capital efficiency, inherent risks, that kind of thing. Yeah, I think it's definitely one to watch, I think.
Yeah, evergreen funds, as I'm doubtless many in the audience are aware, have become very popular, particularly in private credit. So that is a potential area of concern. Let's move on. Now, we've already, both of us, I think, touched upon the subject. This is a time perhaps to get into it in more detail. It's something that, as Samantha just mentioned, we've become much more aware of in the last 2 or 3 years. Particularly, we have a publication, one of our three monthly publications is Sustainable Investment Intelligence. And as Samantha just mentioned, we have a thing in there called the Environmental Investment Monitor, which tracks LP allocations into the various sustainable sectors, no matter how they do it. It's not done by fund category, it's done by what the area is they're allocating into. And we've noticed since we've been doing this that there has been, as Samantha just mentioned, more co-investing, more direct investing, directly into various firms. Sorry, yes, directly into various firms and so on and so forth. Um, I am, and I had this discussion with one or two people who are in the operational due diligence business on behalf of various LPs, and they tend to agree with me. Um, they are not, and I'm certainly not convinced they really understand what they are investing in. And they do it, particularly, this is particularly sustainability, and perhaps one shouldn't exaggerate too much beyond sustainability. When I say sustainability, I mean both various very interesting parts of the investing, the fast-growing natural capital world, but also renewables. And there's been a lot that's been swept under the carpet. Occasionally, things do come out in public, and we obviously can only talk about the ones that do come out in public. So, Samantha, do you want to just mention the VZB situation and the Thurrock, which is the same county that you're in right now, which is Essex? What did VZB invest in?
So obviously this is the German dentist pension fund. Now this is a 2.2 billion euro fund, so relatively small, but they have wiped out half of that. So they've lost reportedly 1.1 billion at least. They had a failed investment into a California recycling firm. They also have another failed investment into a North German shrimp farm. They and another one into a German insurance startup, but they didn't cut their losses. They took on debt under the advice of their financial advisor, who they are now suing alongside their previous auditor. Now, Thurrock pension fund, I believe they invested 650 million into 50 solar farms.
That's pounds, by
Um,
the way. So
yeah,
nearly a billion uh, dollars.
yeah, and the holding company went into insolvency. So it was quite a significant failure back in 2022.
Yeah. So that's quite a famous one because that got into there was I think there's fraud that was alleged and I think there's ongoing cases about that that are happening
Mhm.
even to this day. And when I know the person who was advising Thurrock, who got not at the time when they allocated, but came in afterwards, and he was the one that was unearthed the problem. They were blissfully unaware of the problems until my friend discovered it, or his company discovered it for them. And the point is, and he would say this if he was here, when you get into sustainability, quite a lot of pension funds in particular, and maybe other areas in the LP universe, they think they're doing good. So in many cases, their guard is lowered when they're making these allocations, and they're partly doing it. I don't want to exaggerate this, but in some cases, they're partly doing it for PR reasons. They want to be able to put, as my good friend Chris Addy from Castle Hall, which does advise institutional investors in this area and other areas too, said in the webcast he did with us a few months ago, they love to put a wind farm on the front cover of their brochure and things like that. They want to be seen as being green. They want to be seen as the good guys. There's tremendous PR value in some of these allocations, but they do not have anyone on staff, and nor necessarily do they have advisors who really understand the complexity of what they are investing in, and that has been causing a lot of problems. There are certain situations which we can't really talk about because we're not exactly sure where they'll go, and it's all been swept under the carpet. But there's enough that's out there in the public realm for me to be able to make that statement pretty categorically. I mean, what on earth pension funds are doing, investing directly in shrimp farms, in Hawaiian coffee businesses. We know of here in the UK another pension fund that's investing in oyster beds and all the other stuff. And I would very much doubt that there are any oyster bed specialists at that particular pension fund. It's not that large, or even the advisor that got them into it necessarily would be an expert on what happens with oysters either. But they are investing in these areas. And as Samantha says, it can end in tears with various lawsuits flying a few years later. And then the big one, which we've just come across in the last month, is the court case here in the UK of MFS. So over to you, Samantha. Do you want to give more detail on some of this?
Yes, so MFS used a structure, at least six warehouses. Now, this isn't an abnormal structure for private credit. It's very much routine. However, they did allegedly, seek two different service providers in Intertrust Group and TMF Group. This meant that either one could not see the whole collateral pool. They could not see each other. Um, and as such, the verification infrastructure that was meant to be independent, and each provider assumed that it is independent, was not wholly independent of MFS, who still controlled, issuance of loans and that kind of thing. So the issue isn't that, there's a fraud. It's the fact that no one kind of cared to dig a little deeper. I believe Unicus investors stressed that all of this was visible in the public disclosures. Just you have to dig a little bit to unveil it. So again, it's the classic case of, systemic governance failures for private credit.
Yeah. Right. So moving on. These are all topics now for the next 5 minutes we would have been going into in more detail if we kept to the original plan before we got into the subjects we've just been talking about. Two forms of digital infrastructure. Sorry, I should start by saying we just, for lack of time, we just picked out some of the major areas. There are several others we can or could have gone into, and we do go into these things in the NED indeed, and then one of our other publications as well. So we will be getting into the detail if these are areas of interest in our publications. But for the point of this short presentation, let's just focus on we find what's going on in the data centers absolutely fascinating. Now, coming back to the point we were just making about direct investing by LPs, there's been an explosion of LP, particularly pension fund co-invests into these data centers, which, as we all know, have been absolutely exploding onto the market in the last few years. And it is one of it's the part of the AI bubble, which is the reason for their extraordinary growth. I repeat the point I made a few minutes ago. We really do not think that there has been all the way through. If you look at even these are large pension funds, sovereign wealth funds, family offices, endowments, and the like, how much they really understand about what they're investing in is the open question. By the way, and this is quite an important subject for us anyway, we are doing at IFI Global the first proper risk management research study for our subscribers, starting, we hope, next month, certainly very soon, on our data center risk management. And it covers a multitude of SIMS risk management in many different areas. This is not a topic really for today. So I'm just going to pick out two very quickly due to our time constraints. One is what happens if the AI bubble, we put here bursts. It's not necessarily if it bursts, but let's just say the projections for the growth of AI aren't, they're still good, but they're not as strong as so many of, we look at endless forecasts about how much this market's going to continue to grow. Let's just say it's off by 5 or 10%. In terms of the growth projections, you have massive overbuild risk. I mean, you've got data centers being built all over the world. Extraordinary costs are going into doing that, and if the demand isn't going to be there in a few years' time, there is certainly an overbuild risk. And of course, what will happen is if those centers get built, which they are or will be, then there will be tremendous cost competition to get tenants into those particular buildings. The other thing which no one's really thought about very much is, the technology is advancing so quickly in AI at the moment. Who's to say by 2030 that the whole current iteration of AI hasn't taken a leap forward into another direction, and a lot of what goes on inside data centers is made redundant by then. That's also, I would have thought it's a decent possibility that could be the case. Besides that, and we're involved with a climate risk firm called XDI, who's done some work in this area of climate risks around data centers. XTI, not us, is firmly convinced that the people who built data centers, A, the people who are investing in data centers, B, have seriously and significantly underestimated the climate risk of these entities. Their research from, I think, the mid to latter part of last year shows that something like just over 25% of the world's data centers are at risk of damage from climate change. They've divided that between high and moderate risk. Roughly half of those 25% are at high risk and the other half are at moderate risk. We, with them, are going to be looking into trying to find out how much the very well-known managers who are involved in this, alongside both the GPs and the LPs who've been doing this, how much they are aware of the individual sites that they are allocating to, how much they are aware of the real climate risk in those sites. So those are just two. There, by the way, in preparation for the research I just mentioned, we've come across about 10 different areas of risk. And that doesn't even include geopolitical risk, because two of the data centers we understand in the Gulf region have been affected by the current crisis in that part of the world. So maybe we should have an 11th one for geopolitical risk as well. So that's just a quick aside on data centers. I'm going to hand over to Samantha to talk about blockchain. This is just the summary headline areas.
Yes, so blockchain, has its own inherent risks. Obviously, the first is cross-border legal complexity. Not all jurisdictions have their own legislation in place to protect investors using it. Then you've obviously got cyber attacks and fraud. Blockchains are, especially public blockchains, are very vulnerable to cyber events and from attacks from all over the planet. And then finally, you've got operational risk. Network outages are very present, I think. For public chains, they obviously have, contingencies in place to either halt trading or, backup things that occur. It should also note that management of the blockchain itself is also important. So you should really have, technical expertise that can deal with, instances of where a blockchain splits, for example. So a blockchain does present kind of nuanced issues that perhaps aren't well known yet.
Okay, right, moving on. The two other areas of digital risk that we quickly want to mention today. Again, over to you, Samantha.
Yeah, so in the realm of crypto, you obviously still have Ponzi schemes. Now, the most recent, as of last week, I believe, JP Morgan Chase has been named in a lawsuit against Goliath Ventures. Now, the investors allege that JP Morgan Chase was aware of the fraud committed by Goliath Ventures, but still continued to service the accounts. This led to losses of about $328 million. So there you've got multiple exchange failures. I believe there has been 17 exchange failures since 2009. Recently, there's been a collection of operational failures. So this has led to, quite large fines. In the US, OKX, which is a US-based crypto exchange, has been fined $500 million for, failures as to operational and compliance requirements. Then you've got crypto token failures. According to research by CoinGecko, 53% of crypto tokens launched since 2021 have failed. 86% of these failures occurred last year alone. So that's quite significant. I will also flag that, on the 10th of October last year, it was the largest deleveraging event that the crypto industry had witnessed. On that day, $19 billion was lost from the crypto market as a whole. So it's still pretty volatile, I think.
Yeah,
And
I
then,
mean, I was going to
mhm.
say, I mean, people talk about the digital infrastructure. When you look at the rate of failures of exchanges, infrastructure, I think, is too strong a word for what's the entities supporting crypto are very weak indeed. And whenever there's a big downturn, as Samantha just mentioned, the exchanges go down like a pack of, I don't know, cards or something like that. Sorry, go on, Samantha.
Yeah, and then moving into stablecoins and tokenization, without going into too much detail about, inherent stablecoin risks like DPEGs, and collateral pool. Um, you've got obviously regulatory fragmentation. Not all jurisdictions have kind of standardized their protections for digital assets and also their legal treatment of digital assets. So it's something to be, aware of. And again, ownership of fractionalized assets. This really becomes important in insolvency. You should really monitor whether the rights of token holders, match the rights conferred by the underlying investment interest itself. Then you've obviously got operational issues. Um, Digital security is very, very present. You've obviously got personal keys, wallets, that kind of thing. And then you've got smart contract vulnerabilities. Smart contracts can obviously be used by a fund to automate certain governance things like distribution, investor eligibility. However, they are fairly prone to coding errors, bugs, that kind of thing. So they really need to be regularly audited.
Okay, thank you. We are rapidly running out of time, so we'll quickly move on. And I want to get to the summary of what we're trying to say here today. Um, we believe, and I've been following this at least since the lead was launched 15 years ago, and through the roaring years of the 2010s to the early part of this decade when the private equity boom was booming, the real estate markets were booming, or in fact, all the illiquid alt markets were booming, and everyone was having a fantastic time. At that point, governance, risk oversight in private markets was in some cases being ignored. At least it wasn't deemed to be particularly important, and we would have thought was not being taken seriously enough at all. And I'm afraid now that that boom period is over, at least temporarily, if not permanently, a number of the chickens are coming home to roost. And I'm afraid the kind of things we've just been talking about today, we're going to see more of in the future. I think that's pretty much guaranteed. The illiquid alt asset boom, as I just said, is over, and as a result of that, we're going to see it's going to be very different. It's not the 2008 crash all over again or anything like that. I don't want to leave you with that impression, but we're going to see the consequences of people who have not felt it necessary in private markets to put in the oversight structures that they perhaps should have done. Um, and The emerging asset boom, in by which I mean particularly the sustainable. I'm finding the sustainable asset boom absolutely fascinating and very, very interesting, very similar in some respects to what happened in the early days of the emerging markets at the beginning of the 1990s. It's got tremendous potential. It's one of the few growth areas in the markets at the moment. It's going to be transformative, and good luck to it. I think it should be, and we hope through SII to be very much following what goes on in that area. But there's undoubtedly in sustainability across particularly in the various different entities that come under the natural capital umbrella, and indeed in renewables, there is a really big governance oversight problem. We keep banging on about this in the NED, and we are trying to now. We're launching the private markets risk governance monitor. We are going to be trying. We're going to try and do something about that. The point we're trying. I guess the point is that there's the the whole point of private markets and the whole point of having sophisticated investing institutions, they should be able to, or they think they should be able to, invest directly or co-invest in some of these schemes. But in many cases, they just don't have, or nor do their advisors have, the kind of expertise to do it. Investing in lots of areas of sustainability, especially in renewables. Renewables is a highly complex area to be investing in. There's so much, there's leverage, there are so many issues to take into account. You need, in some cases, an engineering qualification to understand exactly what's going on. And the people in traditional investment or fund governance often just don't have the skill sets for that. But something needs to be done about it, and that's what we're trying to do here. So coming up, I should just say here at IFI Global Stroke the NED, we are in the process at the moment of consulting on establishing best practice governance standards for private markets and emerging assets industries. We've just sent out our first mailing on that recently. We're going through our subscribers to get their views on that. We're particularly interested in hearing from law firms on that, but everybody in LPs. We're talking to some of the advisors to LPs and the LPs themselves, some of the GPs, and some of the service providers, and of course the directors. So there is a consultation on trying to establish in some of the areas we've been discussing this afternoon, at least and some sort of industry best practice with input from as many people as possible. And then we will be doing a private markets risk governance research study. This is over and beyond the risk research study we're going to be doing in data centers. So that's all we wanted to say right now. I'm going to stop sharing screen and seeing whether we have any questions.
Mhm.
So let's go to that and see what anyone may have said. Do we have any questions?
Yes, we do. So the first one is how much more direct investing is done by LPs today than 5 years ago?
That's a good question, but I have no idea what the actual number is. Nor do I think anybody else does either. We don't have that. But I could have put that question back to you, Samantha, because you mentioned the Environmental Investment Monitor in SII, where Samantha goes in and records, and her predecessor did, I think, as well, but you've been doing this now for the last few years, what allocations are going into various areas of sustainability. And you can see there's a lot of direct investing, there's co-investing, as we've been talking about today, and there's all forms of other forms of investing going on in these areas. But no one, I think, is quantifying that. I can just say from just experience, just looking at our own environmental investment monitor, that it's unquestionably going up. I don't know whether you've got anything you could add to that, Samantha.
Yeah, I would agree. There is definitely a noticeable uptick, especially within the last year, 2 years. It is generally pointed to sectors that they have an interest in. So whether they're pension fund or family office or whatever wants to target, say, natural capital, that will be, they'll be more geared up for, a co-invest or something. There's obviously a growth of funds of one for forestry investment as well. So it's definitely something that we monitor. I can't give you a straight up figure today, though.
Right. Okay. And is that it, or other questions, or?
Oh, so the next question is, why do you think that governance oversight has been downgraded or ignored?
Uh, um, what? Um, I think whilst everyone was making money and things were going really well in the last decade, it's human nature to do that. I mean, the NED was launched in the aftermath of the period after it wasn't in 2008. It was a few years after, but after the 2008 crash, and it took till 2009, 2010, 2011 for some of the horrors from that period to come to light. Everyone remembers Madoff, but there were many, many, many others. I mean, I think we may have somebody in Cayman, or more than one person in Cayman following us. The big drama when we launched this was Weavering. That was a big to do back then. There was the Bear Stearns disaster funds there, Bear Stearns. I could go on. There were several of them back then. So there was lots of excitement, lots of drama, we did lots of events in New York, London, Cayman, even on this subject, and there was a lot of emotion back at the time. But then everything calmed down. Everyone just got on with what they did best, which was making money. And, what was there to worry about? It was all going great. And I'm not saying we are back on the end of, about to return to 2008, although that could be the case. God knows what's about to happen in the Gulf or anywhere else for that matter. But we are undoubtedly in a period of much greater uncertainty than we were just 2 or 3 or 4 years ago. And that is going to mean, because of the failure of LPs and GPs to put the kind of oversight they should have been in place, in place. So we are likely to see a lot more of that. And is that it?
No, so one more question is regarding your consultation on best practice standards, isn't it best left to the regulators?
Somebody else asked me or mentioned that as well, not that long ago. I think it was an Irish law firm. Well, no, we're not trying to supplant the job. And our largest subscriber in the world is the Central Bank of Ireland, and has been for many years. We're not trying to do their job or any other regulator's job, but we do think, because it's such a broad cross-border industry, there should be, if it's possible, and we don't want to get too big for our boots. We don't have the clout to do, knock the industry's heads together, but we'd love to be able to consult with as many people as possible and put forward suggestions about how governance in private markets could be done. This is when I should have defined this. This is beyond, the normal fund board structure that we've written about so many years, so many times over 15 years, including private market funds, kind of things that have been going on, which we've been touching upon today. We would like to establish some kind of sense of, what people should do in order to make sure that they have some reassurance. I mean, no one can stop, mistakes being made, funds failing, or investments failing, I should say rather than funds. But at least there should be some sort of oversight structure around them where people can see what's going on. So we have avoid the MFS frauds and some of the other the Thurrock frauds and some of the other things. And when you come across them, they are so simple to stop. If once I know hindsight is 2020 vision and all of that good stuff, but there are if you don't need a PhD in God knows what to get on top of these things. You just need to do a few basic things right, and a lot of these problems can be avoided. Right,
Mm.
so I think that's probably all. I promised we'd end by quarter 2, and I think probably I want to be good to my word. So unless there's anything else, should we call it a day?
I would just add, I know that I blasted through stablecoin risk, but if that is something that any of you are interested in, we did co-author a stablecoin white paper with Jersey Finance, and it can be accessed by their website if you would like to look into that in more detail. It goes into much more detail about depegging events and reserve collateral pools. So if that is of interest, then it's over on there. But that's about it.
Well, thank you all very much for following us. We're always delighted to see almost as many people are here at the end as were at the beginning, which is always a good sign. And hopefully we will see you the next time. Bye bye, everybody. Bye bye.
Bye bye.